18 months ago, I had a savings rate of 11%. It wasn't terrible. It wasn't impressive. It was the kind of number that feels responsible enough to not worry about, but it isn't actually building towards anything on a timeline that matters. I wasn't making bad financial decisions. I was making a hundred small invisible ones that collectively kept the number stuck. Then I changed one thing, a single habit, implemented into a specific way at a specific time. 14 months later, my savings rate was 23%. Same income, same city, same life. The habit didn't require more discipline or a better budget or a financial advisor. It required understanding one thing about how savings actually works that most personal financial advice didn't give and gets completely backwards. The fundamental problem with how most people save, the conventional savings approach, goes like this: you earn money. You spend money on the things your life requires, and you spend money on things your life enjoys. And at that end of the month, if there's anything left, you save it. That sequence, earn, spend, save, whatever remains, is the reason most people's savings rate stays flat for years, regardless of income increases. Because there's almost never anything significant left at the end of the month, not because the spending was irresponsible, but because spending expands naturally and automatically to consume whatever is available. The money doesn't get saved at the beginning of the month. It doesn't sit patiently waiting to be saved at the end. It gets spent every time on things that were that were necessary, on things that were convenient, on things that are impossible to remember 3 weeks later. This isn't a willpower problem, it's an architectural problem. The sequence is wrong, and changing the sequence, not the amounts, not the budget categories, not the discipline required, is what actually changes the outcome. The habit, pay yourself first, automatically on payday. The habit is called pay yourself first and is not a new idea. George Gleason wrote about it in 1926. Every personal finance educator since has mentioned it. And yet, the majority of people who know about it don't practice it because knowing about it and implementing it in the specific way that makes it automatic are two different things. Here's the implementation that made the difference for me. On the same day my paycheck hits my account, not the next day, not the day after, the same day. An automatic transfer moves a defined amount into a savings account at a separate bank, not the savings account at the same bank as my checking account, where the money is one click away and psychologically available. A separate institution with a small but real friction barrier between me and the money. The amount I started was not impressive. It was $200 per paycheck. Not a transformational number, but an amount small enough that it didn't immediately create a cash flow crisis and large enough that it actually accumulated. The savings happened before I had made a single spending decision that month, and before the groceries, before the gas, and before the social plans that expand to fill the weekend. The money was gone from my checking account before my brain had registered having it. And that last sentence is the mechanism. The habits works because it removes the money from the account where the spending decision gets made before those decisions occur. You cannot accidentally spend money you don't see. You cannot rationalize spending money that isn't there. The savings is not the result of discipline applied at the end of the month. It is the absence of money available to spend at the beginning. And the psychologically, that makes it stick. There's a body of research on what behavioral economists call mental accounting, the way human beings categorize and treat money differently depending on where it lives and how it was obtained. Money in a checking account is spending money. Money in a savings account is different. It carries a label, an intention, a slight psychological barrier to casual spending. And money in a savings account at a different institution requires a multi day transfer to access, carries a stronger barrier still. Money in a retirement account is essentially locked, which is why retirement savings happens at much higher rates than discretionary savings for most people. The pay yourself first habit leverages mental accounting deliberately. Moving money from a checking account into a separate savings account on payday reassigns it from available to spend to already saved in the mental ledger. Even though no physical lock exists, even though you could access it if you really need to, the label changes how it feels. And the friction changes how often you override the label. The second psychological mechanism is adaptation. Within 2 to 3 months of automatically saving $200 per paycheck. Your spending adapts to the reduced checking account balance. You don't feel $200 poorer each month because you never felt $200 richer. The money was never available to your spending brain. Your lifestyle calibrated around what was there, not what was transferred away before you noticed. This adaptation is why small starting amounts compounded into large ones without requiring increasing discipline. Once your lifestyle adapts to saving $200, you raise it to 250. Your lifestyle adapts again, you raise it to 300. Each step is small enough that the adaptation happens naturally and the aggression in the aggregate change over a year is dramatic. And the discipline required at each individual step is minimal. And how I doubled the rate in 14 months is the 11% of 23% journey didn't happen through a single dramatic increase. It happened through six incremental adjustments over 14 months, each one building on the lifestyle adaptation that preceded it. In month one, automated, $200 per paycheck, and I barely noticed it. Month three, I raised it to 275 when I confirmed the cash flow worked. In month five, it got a small raise and automated 70% of the after tax increase directly to savings before I ever touched checking. Month eight, did a subscription audit. The same process covered in other videos, around $140 per month in unused subscriptions. Automated that 140 to savings. That same week, I canceled them. Month 11, refinance a debt at a lower rate, which is impossible right now. Saving $80 per month in interest, automated that $80 to savings immediately. Month 14th, another raise. Same 70% automation rule. The income increases help, but the income increases are not the story. The story is that every time a dollar became available through a raise, through a cost reduction, through a canceled subscription, I automated to savings before it became available to spend. The lifestyle never had a chance to inflate into a new money because the new money was already gone. And this is the stealth mechanism behind the habit. It's not just that you save money, it's that your spending baseline never raises to absorb the savings. Every dollar saved is a dollar permanently removed from the spending pool, and the spending pool adapts down around it rather than fighting to get it back. The three rules that make it actually work. Rule one, same day as payday. No exceptions. Not the day after when you get around to setting it up. The transfer has to happen when any spending decision occurs in the same pay period, the same pay period. Set it up once through your bank's automated transfer tool and never touch it again unless you're raising the amount. Rule number two, separate institutions, real friction. The psychological barrier of a 2 to 3 business day transfer time is enough. Online banks like Marcus, Ally, or a credit union separate from your primary bank all work. The goal is that accessing the money requires a deliberate, multi day decision, not a 30-day app interaction. Rule number three, automate every windfall tax refunds, bonuses, unexpected income, and cost reductions. Anything that represents money you didn't have before gets automated into savings immediately before it integrates into your spending baseline. The question is never, what should I do with this money? The answer is deciding in advances. It goes to savings automatically before the spending brain has time to find a use for it. And what it builds towards doubling a savings rate is not an abstract achievement. It's a concrete change in financial trajectory that compounds in two ways simultaneously. More money saved means more money building interest, dividends, and returns in the accounts where it lives. Less money spent means a lower baseline lifestyle that requires less to sustain, which reduces the number at which financial independence becomes possible and shortens the timeline to reach it. The habit is small, the mechanism is simple, and the results sustained over years is one of the most significant financial changes available to anyone at any income level. Set up the automatic transfer today, not this week, today, and raise it by $25 every time you confirm the cash flow worked. That sequence repeated consistently will do more for your financial life than any investment strategy, any side hustle, or any budget app that has ever been built. The money you save is not the money you don't spend. It's the money you move before spending it gets a chance to find it. Thanks for watching. If you really liked today's video, like and comment below. I'd love to hear from you. Also, if you really liked today's video, feel free buy me a coffee down in the subscription of this, or and down in the description of this video and on the main page of this site. I really appreciate everybody's support, which I haven't got yet, which is okay. That's not what I'm here for. I'm here because I love the tiny house movement. Check out this video to the right, and we will check you on the next one.